Day traders, Raghee here. The market got jolted. What happened this morning? At 10 a.m. Eastern, we had a pair of hot zones. Let me show you what we had. Two economic events sitting at 10 a.m. And really what happens when we have events like this, it's not that all hot zones are going to have equal impact, but especially this JOLTS number. JOLTS is about jobs. Anything that's going to fall under that jobs category is going to be something that the Federal Reserve is going to watch, because the Federal Reserve has a dual mandate. The FOMC is not only in charge of keeping inflation under check. I know, they've done a great job of that, but nonetheless, their job is to try to keep inflation in check, hit that target, and of course, employment, for those of you that may not know the dual mandate. So JOLTS, initial claims to a certain degree, but most definitely non-farm payroll. These are going to be huge macroeconomic data releases that will then map to what we're likely to see and hear from the Federal Reserve come the November and the December meeting. Why the rally? This is interesting. If you've never heard the saying, good news is bad for the market and bad news is good for the market, why does that even apply? When the Federal Reserve is hiking rates, they will continue to hike as long as the issue that they're hiking for, in this case, higher inflation, isn't heading lower. And by the way, there's a really good argument to be made that inflation is heading lower, right? So they're at the tail end of their tightening cycle, the hiking. The other issue is when data comes in poorly, bad, right? Job openings were lower. That's quote unquote bad. That tells the Federal Reserve, oh, we might be breaking the market. Traders will say, hey, you might be breaking the market. Stop hiking. And if you stop hiking, the equity markets will rally. That's how that works. Bad news is good for the market because bad news tells us, hey, Fed, stop what you're doing. Quit hiking. And before any cuts come, must come a pause. So anything that suggests that the pause will come or that there's not going to be that much more hiking ends up rallying the market. And if you watch what happened this morning, let's take a look at three key markets from a day trading perspective. Let's start with the dollar. You might say, okay, Rod, but this is the euro. This is the 6E. This is really the best way to look at the US dollar. What happened here? Jolted. Why? Take a look at when we started to really get going. When did the psychology really pick up? Bearish pre-market, neutral on the open. Here comes the 10 o'clock hot zone. Yahtzee. What do we do after that? Euro moved lower. Why? Dollar moved lower while the euro moved higher. So the US dollar is moving lower when the euro is moving higher. Why is that? Because they have a 90+% inverse negative correlation. What does this mean to us as traders? Dollar got cheap today. That's a big up candle in the euro. Dollar went down. So dollar is reacting to likely the end of the tightening cycle, because when a central bank is increasing rates, when rates are going higher, the currency of the country tends to strengthen. That's the way the currencies move. All right, let's take a look at another place. Let's take a look at treasuries. Again, from a day trader's perspective. All right, what happened with treasuries? First off, bearish pre-market. Remember, gang, what's happening pre-market is not the same thing as what we're going to see after the clearing and after a hot zone at 10 a.m., like the JOLTS. And there it is. Once again, notice how this reacted in the same way that the 6E did. Now, what's this response? What's the movement higher on bonds signify? Lower yields. Yields heading lower. Why would yields head lower despite expectation for another quarter point hike? Because we're not expecting any more. This was a huge number. And if non-farm payroll is a miss, right, or flat, we're going to continue going higher. So NFP, yes, will be another good news. Good news for the market, because bad news is good for the market. All right, lastly, equities. I know, aren't we supposed to be circling the drain? Aren't yields supposed to be killing the market? Isn't the strong dollar supposed to be killing the market? Not so much. We've had a choppy August, which is in line with what we would expect seasonally from August. But let's be fair. Let's look at August. This is July 31, right? So there's August 1. Let's just look at only August on that daily time frame. little bit of weakness. We've retraced a lot of that move now. This is our resistance and support zone. We were looking at a choppy August, and let's face it, that's what we had. And this is why in the Sector Secrets Mastery and in the Futures Room, I have been focusing more on day trading. As long as there is uncertainty around every single jobs and inflation data release, and as long as we're not entirely sure what Powell and company are going to do, shortening the time frame and taking advantage of moves like this are going to make a lot of sense, not only for the remainder of August, but going into September, going into October, going into November. Why November? Because November is going to be the first meeting on November 1 where we could get clarity on what it is that the Federal Reserve wants to do. And in between now and then, it's going to make sense to shorten our time frames. So we can take advantage of a candle like this on a 5-minute time frame, right? This is not about necessarily only day trading. It's about two-day trading, right? Two-day trading. And that just simply means that every single day, it seems, there's something else that's going to rattle the market. So why look for longer-term follow-through when it's going to be difficult? Why not just start with a blank page, a fresh set of eyes, and an open book every morning and say, all right, what do we have today, right? And that's why this is really, if we could stop calling this day trading and call this today trading, I think a lot of traders would understand the value in that kind of being nimble, right? That kind of flexibility. That's what we've got right now, gang. That's how the data is going to work. And if you don't already know now, well, let me just remind y'all, this is happening tomorrow at 8 p.m. simplertrading.com/consistent. I'm going to talk about how we've been consistent through August. I'm not just going to talk about wins, right? Is this the kind of month that, like July, which was a mirage, which was a gift, that we can grow accounts very rapidly? No. We know that no more than 2020 suggested what we should do through 2021, 22, or 23. No more can July dictate how we trade through August and September and October and all these uncertain months. We have to have a different approach. Not that we have to reinvent the wheel, but we have to have a more nimble approach. And that's what I'm going to share with you all, what I have actually been doing, and more importantly, the kind of trades that our members have been getting, right? We're only going to talk about trades that I've been taking in the room, alerts that I've been sending, and the approach and the tools that have been giving me an edge, even in a month like August. All right, gang, that's tomorrow. Thanks as always. If you have any questions, as always, leave them in the questions. I read them. Leave them in the comments below. I read them every day. And as always, thanks for smashing the like button. I'll see you tomorrow at the webinar. And in the meanwhile, gang, remember, let's take it today trading. Be good to each other. Hey traders, Raghee from Simpler Trading. Thank you so much for watching this video. Be sure to leave a like and a comment below. And remember, subscribe and click the bell icon so you'll get notified of the next update. And when you're ready to join me for live trading, be sure to head on over to simplertrading.com. I'll see you in the next update.